Welcome to your own channel, Romance with Finance, a brand of Financial Freedom Hub. On this channel, you get the videos and information related to personal finance. Recently, in the previous video, we learned about international diversification and its pros and cons. Let us continue further, and now we'll learn about more types of diversification. The next type of diversification is diversification on the basis of market capitalization. Let us understand market capitalization with the help of an example. Now you would be introduced to two images. You have to look on those two images and you have to analyze those two images. Let us continue our learning and now understand what market capitalization is all about. These tiny seeds represents small cap companies. It's just starting out. It's young, full of potential. However, it is also vulnerable to a lot of risks, perils and hazards. A decent amount of sunlight, a proper quantity of rainfall and good weather conditions can help this seed to sprout fast. On contrary to it, a tornado, a storm, a drought, or a landslide could destroy that crop or that plant. The plants which have already grown and have turned into a tree can tolerate these events to a certain extent. We all human beings have a life cycle. The trees have a life cycle. Similarly, the companies have a life cycle. Nothing is permanent and immortal in this world. Whatever thing is created will be destroyed one day, or whosoever human is born will die one day. If we talk about the life cycle of human beings, then there are various stages such as childhood, adolescence, teenage, young adult, matured adult, and death. However, in our society where we live in, we witness a lot of premature deaths as well. Premature deaths of children, of teenagers, of young adults. As we human beings have stages of our life cycle, similarly, there are stages for the businesses as well. There are two types of companies exist in the business world. The first one are those which are listed on the stock exchanges, and the second one are those which are not listed on the stock exchanges. You can calculate the market capitalization of any company, be it a listed one or a non-listed one. However, market capitalization is a barometer or a measuring tool for public limited companies and public assets. If we categorize the companies on the basis of market capitalization, then there are three types of companies, which are small cap companies, mid cap companies, and large cap companies. Today's small caps will turn out to be tomorrow's mid cap if everything goes well. Today's mid caps would be the future large caps if everything goes fine. These small caps, mid caps, and large cap companies are compared with the life cycle of a tree. As mentioned earlier about the lot of risks that a seed and a small plant faces while growing. The seed or that small plant is a metaphor which is given to the small cap companies, as the small cap companies have more risks of survival in the business environment. Once the small cap company grows and turns out into a mid cap company, then it is less vulnerable to those risks that a small cap company possesses, and it can tolerate more fluctuations and more volatilities. Once the mid cap company grows and turn out to be a large cap company, then it is less vulnerable to those risks that a mid cap company possesses, and it can tolerate even more fluctuations and more volatilities than the mid-cap itself. The companies having market capitalization of 0 to 5,000 crores are classified as small cap companies. The companies having market capitalization of 5,000 crores till 20,000 crores are classified as mid-cap companies. The companies having market capitalization of more than 20,000 crores are considered as large-cap companies. It is not mandatory that all small-cap companies will become the mid-cap companies in the future. It is also not mandatory that all the mid-cap companies will become the large-cap companies in the future. And it is also not mandatory that all the large-cap companies will keep on surviving in the business environment for the long run, and they will provide consistent returns. As mentioned earlier in this video itself about the premature death of children, teenagers and young adults, that was nothing however a metaphor for the companies which failed to increase their market capitalization. It is not mandatory that all the small cap companies will become the mid cap companies in the future. It is also not mandatory that all the mid-cap companies will become the large-cap companies in the future. And it is also not mandatory that all the large-cap companies will keep on surviving in the business environment for the long run, and they will provide consistent returns. That is why in investing regime there is always a risk associated with the rewards. The bigger the risk, the bigger is the reward. Let us understand with the help of an example. If you look at this image, then the magenta line represents a small cap company which started the business from scratch. The owner took some loans from the financial institutions and also deployed their own capital, and that is why the company started from a negative level on the graph. Further, as it's a small cap company, hence the graph is more volatile comparative to mid-cap and large-cap. The company might not survive. However, if it survives and thrives for the long run, then the capital appreciation is multifold times comparative to mid-cap and large-cap. Here, the seed has turned into a tree, and thereafter it is also rewarding with the fruits. The blue line graph represents a mid-cap company which is less volatile than small cap and more volatile than large cap. Mid cap provides lesser return comparative to small cap and provides more return comparative to large cap. That is why it is said, greater the risk, greater the return. This tree is at its maximum height and it will not grow further. However, we can still be benefited from this tree lifelong by eating the fruits that are grown on this tree. We can also sit under the shadow of this tree. This tree is at its maximum height. Large cap company is like a grown tree which will not grow further in height. However, it will keep on providing the fruits on regularly basis. This is like a large cap company which will grow in the market capitalization in the long run if everything in the business is keeping well. The market cap might increase in numbers, however, the category is already the large cap irrespective of the increase in numbers. It is also to be noted that some small cap companies might not be able to tolerate those events and might collapse. Some mid-cap companies might collapse or might lose the market cap and turn out to be a small cap company. And similarly, some large cap company can become a mid-cap company and then can become a small cap company due to these risks in the business environment. That is why, while diversifying your portfolio, you have to ensure that you have a composition of all of those companies in your portfolio with respect to market cap. There is no thumb rule, however, as we all know about the risk-reward ratio, discussed earlier about the time horizon and about smart financial goals. Hence, we can create a portfolio accordingly. If you think that this video was helpful and you were able to grab some knowledge and you attained some wisdom from this video, then